this is actually where he's wrong, because it's not 5% and 5%, because what it is if I have 100,000 and I earn 100,000, so it's powerful. So let's say I borrow 100,000. Now I'm not borrowing it from my money, so that money never leaves my account. So if I'm paying 5% on that loan, I pay $5,000. Now I'm earning 5%. Now I earn 5,000. So he's saying that's a wash. But here's the deal. This is where the power comes in with this. The next year, this is why you have to have a long-term perspective. If you look at his perspective on how he's explaining this from a one-year myopic, just like in a vacuum, then he's right. It's just a wash, no big deal. And no real benefit or gain. But if you look at this from a long-term perspective, the 5% wash that year, because you pay 5%, so you're paying the 5,000, but you're earning the 5,000. He says it's a wash, but here's where it gets great. Next year, you've got 105,000 that you're earning money on, right? Hey, what's going on, cash flow hackers? It's Chris with Life 180, and this video, I'm gonna be doing a response to the White Coat Investors article that he wrote, or blog post, I should say, that he wrote about the 7 truths of infinite banking. So excited to get into this. I got it right behind me here. So what I'm gonna do is I'm gonna make myself nice and small in the corner so you can actually read what I'm talking about. Boom, magic, here we go. Let's get into this. All right, so the 7 truths about infinite banking, bank on yourself. He calls it the same, so it's important to understand. He gets into this, some of the summary. I've read through a little bit at the top of this. I haven't read, in full transparency, I haven't even read all this article. I read through the bullet points, and I just figured it'd be fun to go through this a little bit and get through it all. Now, he does talk about the top. It's infinite banking, bank on yourself. He gets into the leap stuff right here. You can see, basically talking about, you can call this a lot of different things. Bank on yourself and infinite banking are the 2 most popularized marketing names for this concept. So it's important to understand this. He basically says there's little that has changed about this concept in the last several years. He said he wrote something on this, a while ago, and it's not changed, but he's basically updating it. His summary at the top here is that it's not what it's sold at. It's basically a ripoff. It's sold that you're creating leverage. It's going to be better than your bank account. There's some things that he says, it's not what it's cracked up to be, is basically what he's saying. So let's get into the 7 truths. Now, number 1, infinite banking requires you to buy a whole life policy. Yes, it absolutely requires you to buy a whole life policy. You cannot do infinite banking with an index universal life policy. I don't care what the Doug Andrews, people of the world tell you about that. In fact, that is one thing that he does say right here that I did read, and I got to give him credit for that. He says, because the bottom line is the guarantees inside of infinite banking and the high likelihood of never having a negative year, i.e., there are guarantees. You're not going to have negatives over the long term, and over the long term, this is going to far outperform your fixed savings account, which is where you should keep your emergency fund and where you should keep your opportunity fund, right? So the idea is he's saying that, okay, you need a whole life insurance policy. So at the end of the day, not everybody's going to qualify for a whole life policy. So that's something to take into consideration. But the bottom line is, if you are going to do this, even if you design it properly, you cannot utilize a variable universal life or an index universal life policy. It's a bad idea if you want to be an infinite banker, right? See, if you want to be an infinite banker, you need a whole life policy, right? So he's at least getting that part right. So I got to give the guy credit right out of the gate. He is saying that, you could tell he just doesn't like whole life insurance. And maybe we'll see why. But he's buy a big fat term insurance policy to do that. He's worried about replacing lost income. So yeah, he's just kind of gonna align more naturally, I think, with the buy term invested difference concept. There's a lot of reasons. I've got a lot of videos on why that doesn't work. So make sure you check out the channel, subscribe, hit the bell, or go check out the video section. I've got a lot of just basic money concepts down. I got a whole infinite banking playlist that talks about the good, the bad, the ugly. I am not, just so you know as you watch this, I am not somebody who just blindly believes in all the classic infinite banking stuff, although I do believe, because I do believe probably some of the things that he believes as far as infinite banking being misrepresented in a lot of ways by a lot of people. Not to say that it's a bad idea, but like anything else in life, people screw things up. And people can take the best idea, the best concept, the best thing in the world, and humans will screw it up. And so that's where we are. Number two, the policy must be structured properly. That is 1,000% true. There are ways that you can design the policy where the agent will receive literally 10 times the commission than they would receive in another policy design. And so what you have to do, what I always tell people, is to make sure you work with somebody who understands how to design these policies, because this is where I agree with the Dave Ramseys of the world. Because, I believe that Dave hates life insurance, for example, and probably this guy does too, because of the fact that so many agents stand to benefit from it. If it's not structured properly, the agents will pocket a lot more money. He gets into paid up additions, what paid up additions are. I've got a lot of videos on this. I'm not going to go into detail on this, but he talks about you basically can put money into paid up additions. Typically, to do that, if you want to put a lot of money up front, you have to do a term rider on the policy, and ultimately you can get more money and have more liquidity through the use of paid up additions inside of the policy. It's important. So when he's talking about structuring it properly, he's saying you better make sure you utilize paid up additions. If you don't, it's going to take too long for your money to become liquid. Non-direct recognition loans. Now, this is where he's getting into, I don't know what he says about this, honestly. Let's say you have a policy with $200,000 in cash value and you decide to borrow $50,000 from the insurance company against the policy. Like all loans, this is a tax-free loan, but it is not interest-free. Okay. The fact is, in fact, it may cost as much as 8%. It depends on the company. So yes, that could be the case. So just make sure you're checking out what company you're working with. Most insurance companies only offer direct recognition loans. That's also, well, I mean, I guess that is the case. There are a lot of participating mutually whole life insurance companies that offer non-direct recognition loans. With a direct recognition loan, if you borrow $50,000, ultimately the amount of money that you borrow goes into a different interest crediting strategy, where a non-direct recognition loan, you get charged, there's no change in how your dividend is credited to your account. Now, I did a video on this. You could check it out right up here on the difference between non-direct and direct recognition loans and how it's more noise of a conversation than anything else. So check that out. The idea of wash loans, the concept is just because if you pay up the loan, if you are paying the same percent as you're earning, then that can actually be, I don't know how he says it here, your wash loan, same dividend. So while you're paying 5% on the interest loan, that interest is completely offset by the 5% dividend of the loan. So in that respect, it acts just like you would draw money from a bank on the account. There's no interest. So this is where he's wrong. This is actually where he's wrong, because it's not 5% and 5%, because what it is if I have 100,000 and I earn 100,000, so it's powerful. So let's say I borrow 100,000. Now I'm not borrowing it from my money, so that money never leaves my account. So if I'm paying 5% on that loan, I pay $5,000. Now I'm earning 5%. Now I earn 5,000. So he's saying that's a wash. But here's the deal. This is where the power comes in with this. The next year, this is why you have to have a long-term perspective. If you look at his perspective on how he's explaining this from a one-year myopic, just like in a vacuum, then he's right. It's just a wash, no big deal. No real benefit or gain. But if you look at this from a long-term perspective, the 5% wash that year, because you pay 5%, so you're paying the 5,000, but you're earning the 5,000. He says it's a wash, but here's where it gets great. Next year, you've got 105,000 that you're earning money on, right? You're only paying on the 100,000, so you pay 5,000, but you earn 5,250, right? So now you pay that off, and you basically had a $250 net gain. Now the next year, you're going to have $110,250, and you're going to have this 100,000. You're going to pay 5,000, but you're going to earn 5% on 110,250. And so you start to create this spread and arbitrage over time because of the system, because of being your own banker. Now, it doesn't work in a vacuum in a 1-year spreadsheet cycle like he's talking to. So I kind of don't like the fact that he's just being short-sighted, because the guy's way too smart to not realize that. But anyway, that is the power. So he's right. If you look at it just from a year-to-year basis, it doesn't work. And in fact, if you just look at an infinite banking policy in the first year or two without having a long-term perspective, it's not going to make sense. But when you start looking 7, 8, 9, 10 years and beyond, there's nothing that can compete with it. If you don't have a long-term view, this is not going to make sense to you. If you don't have the perspective of investing in yourself and creating a system that gives you more security, guarantees, opportunity, and control with your money, this is not going to make sense to you. All right, so let's go to the next one. Most of those talking about this concept stand to profit from it. Okay, so this is where I'm actually uniquely qualified. Now, full transparency, I run an agency now. I run an IMO. I have a lot of agents that work for me, that work under me. I am not licensed. Now, I have partnerships with agents, and now they work, like I said, in this system, and my job is to help them. However, from 2016 until literally the middle of 2021, I was creating all this content. Go back, look through the history of my YouTube channel. You'll see that I was creating content on this without any ability to make money on it. Like, I could not sell a policy. You'll see me talk about the fact that I'm not licensed, which, by the way, I'm still not licensed. I still talk about this because I love this. This is something that I'm super passionate about and I believe in. Hence the reason I got back into the business, because I wasn't seeing anybody that was actually creating an organization that would support agents and actually educate them and train them and help them really serve their clients in the most powerful way possible. And so we wanted to create an organization that did that. So full transparency, that's what I'm doing now. And so you may say to yourself, oh, Chris is just standing to benefit from it, but just go look through the history books. For 5 years, I did this without being able to make a dime on it because I believe in this so emphatically. So 4, it allows you to earn more on your cash in the long term. This is another thing that is really good. It's going to beat your money in a bank. We call it the ultimate and asset, right? So I always say, when you utilize a whole life policy properly, it's going to give you a hedge on the downside, and it's going to give you an acceleration on the upside of anything that you do, any investment, whether it's a real estate investment, whether it's your business or what have you. It just is good like that, right? Borrow for the boat, So it's important to say here, this is the thing. In infinite banking policy, when you borrow for the boat, when you borrow for a car, when you borrow for anything like that, there's always a cost of money. The policy in itself, paying yourself back interest. I just did a video about running your expenses through your life and how money works in an infinite banking policy, and ultimately how it's really missold and misinterpreted or just kind of miscategorized. So what I would say is, you're never going to get rich by buying depreciating assets. I don't care what any infinite banking practitioner tries to tell you, you're never going to do it. So make sure you utilize this system buying appreciating assets. Now, if you're going to go buy a boat, and the financing for that boat through another, and this boat, by the way, is just something you need, you're going to get. It's something in your life that for one reason or another, you just are going to get it. You want it, right? Like, that's just where you are. So if that's the case, and you're going to get that boat no matter what, and the bank wants to charge you 8% on that loan, and you can pay 3% with a cash value line of credit through your policy, well, what the heck? I mean, utilize the policy, save yourself the interest expense. That's how it's going to make you better. That's how it's going to allow you to earn more cash in the long term with your fixed money. Now, it's also going to beat your savings account by 40 to 45 times the rate of return over the long haul. I mean, that's historical performance over the past 40 years. It's going, in this decreasing interest rate environment, whole life policies have outperformed any fixed asset like that, and in the world, it's crushed it. So there's no better place to keep your safe, guaranteed money that you need to have liquidity of. There's nothing like it in the world. I always say, if you need money for opportunity or emergency, it should be inside of your whole life policy. All right, so the other benefits, number 5 here. Here's the deal. There are a lot of benefits. Like A, your money is going to be completely protected inside of this from lawsuit. Now he talks about this. Obviously, the likelihood of that is low, but especially if you're buying real estate inside of your portfolio, if you're a real estate investor, having the down payment and all of the equity in the house rather than being out there in cash and exposed to lawsuit. Imagine if you could have that equity stored inside of your whole life policy, which was insulated and protected from lawsuit, right? That's a big deal when it comes to, for a real estate investor to have that protection. Now, the other benefits are if you become critically, chronically, or terminally ill, there are living benefits inside of your whole life policy. That's a huge deal. I know multiple people. My father-in-law was able to utilize and access his life insurance policy for living benefits when he was diagnosed with that cancer. And he was able to utilize some of that money for alternative treatments. And while the traditional doctors and oncologists and the people were wanting to shove chemo and radiation down his throat, said he had 3 to 4 months to live, from a most likely perspective, we took him down an alternative path and we had to pay for this out of pocket, but he was able to use his policy for whatever medical treatment that he wanted. And guess what? He's alive today. And his oncologists are floored. And he's like the miracle case that nobody can understand. So it's these things that are really, really powerful. So, some people are obviously less likely to be sued. It's protected against bankruptcy. It's all these different things. But there are lots of other ancillary benefits that go along with your policy. And by the way I look at it is if you're going to have money in a bank account for emergency or opportunity, think if you're a contractor and you need to have capital reserves for your business, if you're a real estate investor, if you're an entrepreneur and you need money as reserves, why would you ever keep that in a bank when you can have it in a whole life policy, have same liquidity to be able to use as operating? You're going to beat inflation. It's going to get a better return than your bank account. And you have all these other ancillary benefits. It's the biggest no-brainer in the world. So number 6 here, he says it's not magic, right? So he says if you're skipping your 401k or Roth IRA contributions in order to fund this policy, you're almost surely coming out behind. Now, I agree with him. Well, first of all, I think 401k and Roth IRA, I would argue, those are the greatest failed financial experiments of all time. If you look at the results of the people that actually use them, the stats and the math just say that they are. That's the fact behind the equation. However, he does say this does not replace real estate investing. It's a simple way to save up to buy real estate that will actually build your wealth. So I agree with that. Let me put this emphatically clear for you. Life insurance, whole life policies, infinite banking, bank on yourself, this is not an investment. You shouldn't look at this as an investment. It is your storage vehicle for wealth creation. It is a system that you operate inside of, and when you borrow against it, you want to make sure that you're borrowing against it with a certain set of rules to buy appreciating assets, cash flowing assets that will work inside of a system. And when you do it that way, only then will it help you get where you want to go. And so from that perspective, just buying this magical infinite banking policy to get wealthy is not going to happen for you. So don't expect it to. Understand that it's part of a bigger financial system that you have to execute on. Your infinite banking policy is only going to be as good for you at creating wealth as you are as good at executing and leveraging the policy. All right, so finally, number 7 here, he says it's not revolutionary. So a lot of people buy into this concept also buy into conspiracy theories about the world, its governments, and its banking system. Yeah, that's true. That is a big thing that a lot of the people that follow Nelson Nash that created infinite banking believe. Infinite banking, bank on yourself, and leap is positioned as a way to somehow avoid the world's financial system, as if the world's largest insurance companies were not part of this financial system. Your money is still denominated in dollars, subject to inflation. So here's what I would say though. Yes, your money is subject to dollars. Yes, it is subject to inflation. There is no getting around that. But here's the bottom line. Life insurance companies are the best managers of risk in the world, and you're not going to find another company that will get you better, guaranteed long-term returns with the focus on preservation of capital. Now, preservation of capital means preservation of purchasing power, which includes inflation. So from that perspective, he is wrong. Like if you look long-term, the returns inside of your policy are going to outpace inflation because that's what life insurance companies do. If you look back in the 80s, dividend rates were 14%. Guess what? inflation got high, dividend rates went up with it because life insurance companies know how to manage this risk. And so once again, it's all about understanding how to utilize the system. Yes, you can run into some charlatans out there who don't really understand infinite banking. They maybe sell life insurance. They see something about infinite banking. Maybe they sell index universal life. They heard about infinite banking, and it sounds like a really good kitschy way to kind of sell this thing to their people, to a prospect or somebody. But the bottom line is that if you want to make sure that you're working with somebody that understands this inside and out, that knows all the ins and outs of infinite banking. And if you have any questions about this, if maybe you're a new agent and you're looking to learn, or maybe you're somebody who's just kind of going down the rabbit hole a little bit and trying to learn about, is infinite banking right for you? I would really encourage you to make sure you subscribe to this channel. I do videos on this literally almost every day, where I talk about this. I don't think there's another place on YouTube where you're going to be able to find content to be able to go there. You can also follow me on TikTok at Real Chris Kirkpatrick, on Instagram at Real Chris Kirkpatrick, and I look forward to connecting with you there. You can chat, engage with me, comment in the comment section below. I engage with every single comment that I see. Sometimes I guess I miss a few because life happens, I get busy, but I really, if I don't respond to your comment, just keep banging at me and I will get to you, I promise. But you know, I genuinely, I also have an infinite banking playlist that you could watch, and I know that that playlist is probably one of the most informative sets of videos on infinite banking on the entire internet. So if you have any questions at all, make sure you subscribe, make sure you hit the bell, get notified every time I launch a video, engage with me, ask me questions. I do a lot of shorts now. I'm working on starting to do shorts as a response to comments if I think they're worthy of a good 30 to 60 second response. And so that's it. I hope you found value in this. And if you have any questions, once again, engage. Until next video, have a blessed, inspirational day. We'll see you then.